What's going on, everyone, and welcome to your financial dose. Today, the video is going to be about RRSPs, and with the tax season approaching, I thought that this would be a very timely video to help you guys figure out what to do with your money. If you guys don't know, this channel is all about helping you guys master your personal finance goals. So in Canada, what we have is an RRSP, and this is a sort of investment vehicle or an investment account that the government created to enable us or to incentivize Canadians to save money. And this is very similar to the 401k that you would have in the States. So the way this account works is you can purchase stocks, bonds, ETFs, money market funds, and other types of assets in this account, and it would fall under the RRSP banner. And what's so good about the RRSP, or what's known about it, is, well, you get a tax deduction on the money that you contribute. So if you put $5,000 in your RRSP, you get to remove $5,000 from your income, which means that you pay taxes on $5,000 less. So essentially you get some sort of tax credit. So let's assume that the marginal tax rate is 50%. So if you make $100,000, every dollar that you earn above that $100,000 will be taxed at 50%. That's a marginal tax rate of 50%. It's just easier to run the numbers that way. So if you contribute $5,000 to your RRSP and you are making $100,000, well, you get to remove the $5,000 off the income, so then you essentially make $95,000. And what that means is instead of paying income tax on $100,000, you're just paying income tax on $95,000. So essentially, you get $2,500 in taxes back at the 50% marginal tax rate. In order to benefit from this tax deduction, you need to contribute before March 1st of 2020 for the 2019 fiscal year. So you have the month of January and February to put the money in that account, and then the government will register it, and then they will send you the money back or charge you less income tax when the time to pay the income tax comes. So now we're going to talk about how much money you can actually put in your RRSP every year, because it's not unlimited. So what they've done is they said, well, you can either put a maximum of 18% of your income or $26,500 for 2019. And every year this dollar amount would go up, I guess, to follow inflation. So let's say, 20 years ago that amount could have only been 10,000, but now we're at 26,500, and the next year we're probably going to be at around 26,800, something around those numbers. Let's say you make $100,000 a year. You can contribute the lowest between 18% of your salary or $26,500. So in this case, we'd be looking at $18,000 that you can put in your RRSP for that tax year. If you don't use the full portion of your RRSP contribution room, you'll have what we call an unused room at the end of the year. And luckily in Canada, this unused room can be carried forward to the next year. So if you make $100,000, you have $18,000 available, and you only put $9,000 in your RRSP. That means you have another $9,000 available, which you can then contribute for the following year, plus whatever new amount that you get based on the salary that you're making. So you never lose the unused contribution room. What happens when you put too much money in your RRSP? Well, if you put less than $2,000 extra, nothing happens. The only thing is that you can't use that extra $2,000 to deduct against your taxes. Obviously, if you exceeded the limit, okay, you can put an extra $2,000 in the account, but we're not going to give you the tax credit for it, is what the government says. If you go above the $2,000 extra, you're going to be charged a penalty. If you go above $2,000, the government charges you a 1% tax per month over the excess. So the whole idea of this account is to be able to contribute to an investment account to get taxes back, and all the capital gains that you make within the account are not taxed right away. They're going to be taxed in the future. So you get to defer the capital gain tax on those investments. Normally, when you sell a stock or a bond and you make a capital gain, you're going to have to add that gain to your income, and you will need to pay income tax on that gain. This RRSP avoids that. Another benefit of this account is usually if you're working in a company, some companies offer employer matching contribution plans, which essentially what that means is that the employer will allow you to, say, contribute a maximum of 4% of your salary to your RRSP that is controlled within the company, and then the company will match that contribution. So if you put 4%, they'll put 4%. If you put 6%, they won't go above whatever that limit is. Maybe it's 4% of your salary, 2% of your salary, 8% of your salary. It really depends on the company, but they will match up to a certain amount of your contribution. So that's like free money that you get if you actually take advantage of that plan. So if you are in a company that does offer some sort of RRSP contribution matching plan, I would strongly suggest that you take advantage of that because it's free money. So now we've talked about the benefits of the RRSP, but let's talk about the negatives. So first off, the RRSP is an account where when you contribute money, it's very hard to take the money out. There are two occasions that you can take the money out before your retirement. The first one is if it's called the home buyer's plan, and it's if you haven't owned a home in the past 5 years, then you can take out up to $25,000. And if you have a spouse, they can also take up to $25,000 for a total of $50,000 to buy your home. This is a great tool for people who have been diligently saving in their RRSP, but then needed more money for the down payment for their home. However, you can't just take the money out and leave it at that. You have 15 years to pay back the loan that you took from yourself. The next moment where you can take money out of your RRSP without being penalized and without retiring is under the lifelong learning plan. What this plan allows you to do is you can take up to $10,000 per year to a maximum of $20,000 over 4 years. So you can take out $5,000 every year, or you could take out $10,000 every year for the first 2 years and then take out nothing for the remaining 2 years to pay for your or your spouse's education. This isn't for your children, this is just for you. And again, you have to repay this amount in 10 years after you've finished the whole lifelong learning plan process. So what happens if you actually withdraw money before your retirement and not under those two plans that we just mentioned? Well, you're going to be charged a withholding tax. So if you withdraw between $0 and $5,000, you're charged a 10% withholding tax. If you withdraw between $5,000 and $15,000, you're charged a 20% holding tax, and anything above $15,000, you're charged a 30% holding tax. And what this tax does is if you take out, $10,000, you're charged that 20%, so you have to give $2,000 back. And if your marginal tax rate is higher than the withholding tax, then you'll have to pay the difference between the two. So if your marginal tax rate is 25% and the withholding tax was 20%, you'll have an additional 5% to pay when it comes time to pay your income tax. And the reason they do this is essentially what you do is you're taking money out of your RRSP and you're adding it back to your income, so you have to pay tax on it. If you live in the province of Quebec, it's a bit different because you have a withholding tax at the federal level and the provincial level. So the federal withholding tax is lowered to make room for the provincial withholding tax. And again, it's important to note, if you withdraw money prematurely from your RRSP, you cannot recontribute. So that room that you took out is permanently gone. So if you had a maximum of $60,000 that you can put in your RRSP that you've accumulated over, let's say, 10 years of work, and you take out $10,000 prematurely, you cannot put those $10,000 back in the account. Ever. We just talked about how the RRSP worked, but hey, how do I actually get to pull money out during my retirement? Well, what you need to do is you need to convert your RRSP into a RIF account, or a registered retirement income fund. This will enable you to convert the plan where you're putting money into a plan where you get to take money out. So anyone with an RRSP has to convert that account into a RIF by the age of 71. Otherwise, it'll happen automatically and you will no longer be able to contribute to that account. You can only take money out. And the amount that you have to take is determined using one of two formulas. So if you converted your RRSP into a RIF before the age of 71, this is the formula that dictates the minimum amount that you have to withdraw every year. So you're going to take the market value of the RIF at the beginning of the year, and you're going to multiply by 1 divided by 90 minus your age. So if the value of your registered retirement income fund is $100,000 and you're 65 years old, that means that you have to withdraw a minimum of $4,000 per year. If you are above the age of 71 or at the age of 71 when you convert the account, you have to withdraw the minimum amount of money based on the following table. So if you are aged 71, you need to withdraw minimum 7.38% of your account. And if you are 94 plus, you need to withdraw 20% of the balance of your account. And when you withdraw the money, this money gets added to your income tax, which means that yes, you got a tax deduction or a tax credit, let's say when you initially contributed to the account, 20, 30, 40 years ago, but now that you're pulling the money out, this is when the government gets its taxes back. This is when it gets added back to your income, and then they get to collect the income tax. This is the reason why I'm not such a fan of RRSPs, because if you, let's say, contributed $50,000 towards that account throughout your life, and that $50,000 grew all the way to $250,000, well, now you're going to be paying taxes on an amount that's 5 times larger than the initial contributions that you've done. Another thing to keep in mind is this only makes sense to contribute to an RRSP and get tax credits back if you are expecting to make less money during your retirement. If you're making $100,000 as a salary and then you retire and you're making no money, your tax rate is going to be lower. So you will end up saving on taxes because you've deferred the $100,000 tax all the way to a point where your income was much lower than what you used to make, so you pay much less tax. However, if your income is higher than what it was when you were initially contributing to the RRSP, you're kind of paying more tax than what you would have paid initially, because when the income gets added back to your overall income, you end up having to pay more tax because you're going to be in a higher tax bracket. And finally, what happens when you pass away? Because yes, this is not necessarily the most fun thing to talk about, but it's something that you need to keep into account when you're planning your estate. For the RRIF, on the date of your death, if you don't have a spouse to transfer it to or dependent children to transfer it to, it will be taxed. The entire balance will be taxed. So if you have $300,000 remaining in the account, those $300,000 will be added to whatever income, and then they will be taxed at that tax rate, which is extremely high because the whole amount that is in the account gets taxed all at the same time. You don't get to withdraw it over 20 years. It all comes out right away. So in this case, it's much more beneficial to be able to transfer it to a spouse or to a dependent children and sort of save on those taxes or not pay those taxes right away because you get to transfer them tax-free. Overall, the RRSP was a good vehicle made available to Canadians to sort of incentivize us to save money. At the same time, we need to understand that it's not all beneficial to us because A, we can't withdraw our money when we please. B, we are going to be paying much more taxes, or the tax base of our account is going to be much larger in the future because we initially contribute smaller sums of money. Over the years, compound interest expands that amount, and then at the end, when we're ready to pull the money out, the account that we're going to be looking at is going to be much larger than what we initially invested. So just keep in mind that if you are also making more money in retirement and you have more money to be taxed on, maybe the RRSP wouldn't be the first investment account type that you should pick or that you should fill up first. Maybe the tax-free saving account, which I'll talk about in my next video, will be more beneficial to you. Well, thanks for tuning in, guys. Hope you learned something. As usual, if you appreciate the content I'm putting out, yes, this is a very new channel. Yes, it's going to be growing hopefully in the future, but feel free to subscribe and to like the video. It really helps me out. If you have any questions or comments, also please feel free to post them in the comment section and I'll get back to you as soon as possible. Thanks for tuning in, and I'll see you in the next one.